Right, are you with me? What happens is, the lenders feel comfortable that you have 20% equity in your house, and I, as the borrower, have borrowed 80%. So I own 20% of the house. So if the house goes down in value, the lender's still protected, right? So the lenders feel comfortable at 80% loan to value. When you start going above 80% loan to value, which means that you're putting down less money on a purchase, are you with me? What goes up? The risk. Your payment goes up also, but your risk goes up, right? So as a lender, if the risk is going up, what am I going to do with your interest rate? And if I make your interest rate higher, what else goes up? Your payment. And is it possible that your payment might go high enough where you're not qualified to buy that house anymore? So everybody loses. But if I'm a lender, and I have somebody else, first name, Gail over here says, hey Doug, I own a company. I'm going to collect a little bit of money from the borrowers, and I'm going to ensure you that if the borrower, between 80 and 90% that they borrowed, that 10%, I'm going to insure that risk. So if this loan is underwritten in a proper way, and it defaults, I'll give you back whatever is between 80 and 90% at the time. So how do I feel as a lender? Great. So instead of making the rate 5.5%, I might be able to make it 5%, right? So that might save a lot of money in the payment, although you're going to have to pay PMI, but it might help qualify. And after a certain number of years, what would happen with that PMI? It could drop off. Years ago, and you're in the business 16 years, you said? 12 years? You may or may not have done this. How long are you in the business? It's kind of supposed to be. Did you guys ever finance a house and then next year when the property value went up, get it reappraised and drop off the PMI? Yeah, we're not allowed to do that anymore. We have to keep it on for like 5 years or something. They make us pay them because they found out that we knew some of the tricks. Are you with me? All right, so PMI, private mortgage insurance on conforming or conventional loans. 80% or higher loan to value. With mortgage insurance premium, that's on what kind of loans? FHA. All FHA loans, no matter how much you make, no matter what your credit score is, if you're qualified to get an FHA loan, we all pay the same rate. Are you with me? So let's say in this particular case they're paying $100 a month. What's a HOA do or a CAM fee? Condos, co-ops, townhouses, homeowners association dues, or common area maintenance fees, right? If we had these, sometimes the taxes and insurance is included in it. I'm going to say we didn't get one of those loans. We got a regular house here. So here we got what? $865, $915.30 would be the monthly payment to the bank. When the bank receives this payment, what do? They put the whole thing in escrow? No, they send this to the mortgage lender, whoever that is. They put this where? In escrow. And what do they do with this? They send it to the PMI company. That's how they break up the payment. I'm going to go back to LTV in just a second. You guys have asked some good questions. I just want to make sure I cover a couple of things. There are actually 3 types of amortization in this business. So let's say this is the principal amount that somebody borrowed. Okay? Let's say it's $100,000. What's that? The term is 15 years, 20 years, 30 years, does not matter. Can somebody tell me what the 3 types of amortization are in this business? In mortgage lending. Anybody want to take a stab at it? Adjustable is not a type of amortization. Yes? What'd you say? What kind? Negatively amortized is correct. That's one of them. So watch. I'll show you how all 3 work. Very good. You pay attention to your mother's classes, huh? All right. If somebody borrowed $100,000, whether it was a fixed rate or an adjustable rate, makes no difference. As long as you are making the full principal and interest payment every month, after whatever term it is, it could be a 30-year deal, you're going to have it paid off in full. Because you're paying the full amount of principal interest. That's called a fully amortized loan. fully amortized loan. So, if you got an adjustable rate, this month the payment is $600, next month it's $800, and if it's a monthly or it's a yearly, whatever it is, if you make those payments for the 30 years, whatever it is, it gets paid off in full. Done, zero balance. How many people here have known somebody in their family or done it themselves where you had a mortgage burning party? Oh, I see one hand here. Did you have? Yeah? I'll come to you first. Tell us, what happened? What's your name, by the way? Hi, Crystal. Who did it? Ooh, the church. So your church paid off their mortgage, invited everybody over, and you had a 55-gallon drum, right? You poke some holes in it, you put the lumber in there, start the fire, and they take the mortgage and they drop it in there and burn it up because they don't owe that bank any money anymore, right? Something similar? Your church, okay, great. So you have the board. What's that? And your parents did it too. So, I'm from, Brooklyn, Queens area where you got those little postage stamp backyards. You got the above ground swimming pool. You got the hibachi grill back there, right? You put 500 people back there and you're all hanging out. They used to have parties and they used to do the mortgage burning party back there because they paid off their loan fully amortized. You with me? Now you said, tell everybody your name. Nice and loud, George. I know you got it. George! Okay, George. George said, and you should give your son $1 for that answer. Negatively amortized. Look, here's what happens. If you're not paying enough money to pay off the interest every month, let's say the interest portion of your payment is $600, and you only pay $300. Let's say the lender allows you to do that. There's $300 in interest. Are you leaving us for good?
I'll be back.
All right. What happens is, if you're not paying the full amount of interest, the bank still has to get paid. So they add that on to the principal balance that you have. So your principal balance will go up every month. Fair enough? That's called a negatively amortized loan. Somebody say it's crazy? Well, I'll talk about that in a second for you so you get to know. The third type is interest only. So you borrowed $100,000, 7 years later, how much would you owe? $100,000, right? Those are called balloon payments and stuff like that. Let's talk about the negatively amortized loan for a second. Just so you kind of get an idea. This is what happens. It relates to loan to value. By the way, could you guys in the back see this? You couldn't see that? All right, hold on. Take this home, you put this in your wallet, all right? You go home tonight, you show the kids what you learned, all right? All right. All right. So, what was I rambling on about? No, negatively amortized. So, you used to have what they called, well, first of all, how many people think those option loans or quick payment loans were bad loans? Show of hands. Anybody think they were good? Here's the answer, it depends. Are you with me? All right, so look, I'll show you quickly how this works. So on the pick a pay, right, this is the way it would work. You would get a 15-year option. It might be $6,000 a month. You might get a 30-year option. It might be $3,800 a month. You might get an interest-only option. It might be $2,500 a month. You might get a minimum payment option of $500. What do you think most people would pay? $500 a month. How short are they every month?
That's why so many people chose lessons now.
You have to know what's going on. How many people know the suit maker? He's out of business now, Cy Sims. Anybody hear him? What was his tagline? An educated consumer is our best customer. Education is important. There are, but we went over, I think I did this earlier because I don't think I said it to you guys. Are there good real estate agents and bad real estate agents?
Yeah.
Are there good lawyers and bad lawyers?
Yes.
Are there good loan officers and bad loan? No, there's only good loan officers. There's good and bad and everything, right? You don't know all this stuff. The bottom line is, if your interest-only payment is $2,500 and you're only paying $500, you're $2,000 short every month. If the lender allows you to do that, it's okay. But here's what happens, why education is important. These loans are designed for a certain type of borrowers. Not everybody. Are you with me? So, let's say, for argument's sake, what's your name over here?
Rich.
Rich. Let's say Rich works on Wall Street. Rich makes some nice money, and every January, oh, you didn't know that he does this? He makes a $150,000 bonus. He gets paid in January of every year. He's been doing this for 5-6 years. Is that pretty cool? Does he understand stocks and bonds? He's a smart guy. Does he understand risk? So, you guys want to buy a house. You can pay $6,000 a month. You can pay $3,800. You can pay $500. Rich, hi Rich. You're going to pay the $500. Why? Because the difference between what you would pay on a regular mortgage is $3,300 a month. What are you going to do with that $3,300? He's going to put it in stocks, bonds, invest in everything, right? Are you with me? Maybe buy a Bitcoin or two. If the market goes bad, he can't afford to make his mortgage payment anymore. Was he an adult? Is he intelligent? Of sound mind? Does he understand risk? Okay, great. Could this be a good deal for him? Because if he's borrowing money from me at 4% and he's investing it at 22%, is he smart? He's brilliant. Good loan for him, isn't it? Yeah, say it's a great loan. All right, it's a great loan for him. He also understands that as soon as he reaches 125% of what he originally started with, so if he borrowed $500,000, as soon as he gets to $625,000 in 2 years, you have to start making the full 30-year payment. So you got a couple